Well, today's trading session left a lot of us asking, is this the beginning of a recession? The Dow Jones Industrial Average plummeted to the weakest point today, around 1,000 points. It was not only contained in Dow stocks, all the indices were in the negative, as well as many overseas markets as well. This was a broad-based sell-off. This included names like Intel. That was down to the lowest level, around 25%, even a little bit more than that. It was the worst day Intel stock seen in about 50 years. In addition, the VIX, volatility index, that's the fear index, that hit levels almost at 30 at one point. This is the worst day, the highest day for the VIX, going back to March of 23. Today was a significant day to the downside. The jobs numbers, that started off the selling, they were not good at all. Non-farm payrolls released. 114,000 jobs were created following last month's 179 and before that 216,000. These prior numbers also were revised down, so the picture certainly is not good. In terms of the non-farm payroll services, that's shown in blue. That showed us the biggest decline over the past couple months. It's important to note, compared to the goods or the non-farm payroll government, it's a service-driven economy we have here. So we see the decline in the jobs hits at the very core of our economy, services. The unemployment rate also rose. We're now at 4.3%, following last month's 4.1, 4.0 before that. Speaking of the unemployment rate, we have to talk about the SAHM Rule. We spoke about this recently. We didn't know it would come back so quickly. This identifies times when the unemployment rate begins to accelerate higher. The rule was put together by Claudia Sam, Federal Reserve macroeconomist. And essentially, it identifies recessionary periods. In blue, unemployment rate. In gray, those are the recessionary periods accurately defined by the SAHM Rule, showing us, for example, in 1991, captured the acceleration, the increase in the unemployment rate. It also did a good job of doing so in 2001 and 2. Also, 2008 captured that skyrocketing unemployment rate at that point. More recently, the COVID crisis in 2020. And now, for the first time since 2021, we have a new trigger. Now, how do you calculate the SAHM Rule? It's actually very easy. You take the unemployment rate, you take the 3-month moving average of that unemployment rate, and you look to see when that moving average is at least 0.5% greater than the lowest low that the unemployment rate achieved over the past 12 months. You see, you create a base for the unemployment rate at the low. You say, okay, if it accelerates higher, that shows us there's a recession. It's not so important whether the unemployment rate is 4 or 4.1, but rather how fast it's moving. Well, now we can see, we do the math, we have the unemployment rate of 4.3%, the 3-month moving average of 413, and we see for the first time, again, since 2021, 0.53% spread. We have an official trigger of the SAHM Rule, which we've seen in the past, does accurately capture recessionary periods. Now, Fed funds futures are pricing in even deeper cuts. If you have not seen our video just yesterday, we spoke about how the Federal Reserve or the Fed funds futures following the Fed meeting this Wednesday. Seems like a lot's happened this week. On Wednesday, the Fed met. Afterwards, the Fed funds futures predicted there's a 100% chance that the Federal Reserve is going to cut rates in September, but only by a quarter point. Well, that has all changed now. What we're seeing now, this is today's daily change. Today's daily change, we can see the chances in September, during the September meeting, that we're going to have interest rates only a quarter point lower at the 5 to 525 level. Those probabilities went down by 50%. The probability that will be down half a point now, that rose by 50%. So yesterday, we had a very strong chance in September rates would be cut by 25 basis points, quarter point. We're now looking at a half a point cut. In November, yesterday, we had the probability we'd only be down half a point. Now we're talking about 3/4 to even a full point lower. In December, The odds that we would only be down to 4.5 to 475, that has now declined quite drastically. We're now predicting much deeper cuts. I believe even I heard there's certain banks, Citibank, for example, they're predicting 125 basis point cuts, 1.25% by January. And speaking of which, January, it's off the charts here. We're now expecting a much more aggressive Federal Reserve cut. Now, keep in mind, we have meetings in September and then November and December. The meeting in November occurs just a few days away from the elections. Federal Reserve is supposed to be completely independent, but of course, there's a lot of pressure in both directions. Here is where we stand now. On the left-hand side, in September, we have the highest probability that interest rates will be at 475 to 5.0. That represents a 50 basis point or half of 1 percentage point cut. In November, the greatest chance will be down 75 basis points. In December, the greatest chance will be down a full percentage point. So everything is really ratcheted a quarter point lower than where we were yesterday. And in January, again, it's off the charts. There are many economists expecting over a 100 basis point reduction by the time we hit January. The inverted yield curve, by the way, is also flattening, and there's a very important message that we can take away from this. Notice these are the bond changes over the daily in blue, weekly in red, and monthly changes in green. And in particular, notice what's happening in the bond market. We see the greatest decline in yield on the short-term maturities, not the ultra short-term, not the 3-month T-bills or the 6-month T-bills, but the 1 and 2 year short-term bonds. And what's happening is that the yields are coming down, that there's the anticipation, and the short-term yields, we spoke about this again yesterday, the short-term yields most accurately reflect the expectation of near-term interest rate decisions, and that has now begun to move. Yesterday, this was not the case. A lot really has changed in the past 24 hours. In blue, 1-year bond. In white, 10-year bond. In red, that's the spread, the 10-1 spread. Of course, the 10-year in white is below the 1 year, so we still have an inverted bond market. But notice what's happened. We now see a huge reduction in the inversion, so to speak. Why? What has happened? It's that 1-year bond. We've seen a collapse in the 1-year and 2-year short-term bond yields because of today's jobs market, jobs report, also the stock market and everything that's going on. We're now seeing and also, of course, the Fed funds futures we just spoke about. We're now seeing a much more likely scenario with lower interest rates sooner. And that's why the 1-year and 2-year bonds really kind of woke up today. What's the next step? This is what we really need to watch out for. In gray, S&P 500. In blue, that's the 1 year. In red, this is a 10-year. Now, this is 2008, but it's important to reference this, because it's a very common template when we're looking at this kind of scenario. Notice what happened as the inversion ended. The 1-year bond, that's in blue, collapsed below the red line, the 10-year. What moving forward, when next week we don't have a lot of jobs number or a lot of economic numbers, we have Fed speakers, and of course are right in the middle of earnings season. What we want to see is the relationship between the 1-year and the 10-year. If the 1-year really starts to collapse, and also the Fed funds futures will agree with that type of move, if we see a growing expectation that the Federal Reserve is going to cut rates faster, there's even some talk they may cut rates before the September meeting. But if there's expectation they're going to cut rates faster, well, if we look back in time in history, we usually see recession starts when the Fed starts cutting rates. That doesn't make sense. The Fed cuts rates. That should be good for the economy. But the fact of the matter is, if the Fed cuts rates, the Fed's usually late. So if they're cutting rates, it means they should have already. So it's taken us a negative. Of course, it's not a guarantee that we're going to go into a recessionary period. Not at all. We certainly want to see the GDP stay in positive territory. The last month's data was good. today's development not so good. So there's a lot left to be seen, but this is what we want to watch for, is the 1-10-year relationship. We hope this has been helpful. We look forward to seeing you back soon.